Ever wondered what mortgage interest is and how it works? Well, let's unravel this financial term together. Simply put, mortgage interest is the fee you pay to a lender when you borrow money to buy a home. Think of it as a thank you gift for the lender trusting you with their money. It's calculated as a percentage of the loan amount you borrow, and it's not a one-size-fits-all kind of deal. It can vary, and how much it varies depends on a few key factors. These include the term of your loan, the amount you're borrowing, and your own financial situation. Yes, your credit score and income play a significant role here. So, you see, understanding mortgage interest is like holding a roadmap to your home buying journey. Now that we've skimmed the surface, let's delve a little deeper into how mortgage interest is calculated. But before we continue, if you like this video, please remember to share it with your friends, hit the like button, subscribe to the channel, and then watch some more of our videos. So how do we calculate mortgage interest? Well, the calculation of mortgage interest is not as complicated as it may seem. It's a straightforward process that involves the annual interest rate and the outstanding loan balance. The interest rate is a percentage of the loan amount that you, the borrower, pay to the lender for the privilege of using their funds to purchase your home. The outstanding loan balance, on the other hand, is the amount you still owe on your mortgage. To calculate your monthly mortgage interest, you simply multiply your outstanding loan balance by your annual interest rate and then divide that number by 12. This gives you the amount of interest you'll pay for that month. Now, let's talk about your monthly mortgage payments. These payments are not just about interest. They consist of both principal and interest. The principal is the portion of your payment that goes towards paying down the original loan amount, while the interest is what you pay to the lender for borrowing the money. Over time, as you make these monthly payments, the principal portion increases, and the interest portion decreases. This is because as you pay down the principal, the outstanding loan balance decreases, and therefore the amount of interest calculated also decreases. This process is known as amortization. However, it's important to note that interest compounds over time. This means that the interest you owe is added to your outstanding loan balance, and then future interest is calculated based on this new higher balance. This is why it's often said that paying extra towards your principal, especially in the early years of your mortgage, can save you a significant amount of money over the life of your loan. Remember, understanding how your mortgage interest is calculated can help you plan your finances better. So, don't shy away from these calculations. Embrace them, and let them guide you towards a more secure and informed financial future. Now, what happens when mortgage interest rates fluctuate? Well, let's dive into some recent news to understand this. Mortgage rates have recently surged above 7%, a result of the Federal Reserve's attempts to combat inflation. This increase in rates has a significant impact on home buyers and their purchasing power. You see, when mortgage rates rise, the cost of borrowing increases. This means that a home buyer's monthly mortgage payments will also rise. To put it in perspective, at these new rates, the average monthly payment for a typical buyer has increased by $878 compared to the previous year. This rise in monthly payments directly affects the affordability of homes. The higher the mortgage rate, the higher the monthly payments, and the less affordable homes become for the average buyer. This has led to a decline in home sales as potential buyers are priced out of the market. But it's not all doom and gloom. Some buyers are still entering the market. In fact, mortgage applications have shown a slight increase despite these challenging conditions. So, what does this mean for you as a potential home buyer? Well, it means that you should be aware of the current mortgage interest rates and how they might affect your monthly payments and overall affordability. It might also mean waiting for more stability in mortgage rates and economic conditions before making your purchasing decisions. It's also worth noting that while rising rates can make buying a home more expensive, they can also be an opportunity for those looking to invest in the housing market. As rates rise, home prices may fall, creating potential bargains for savvy investors. So, keeping an eye on mortgage rates can be beneficial if you're planning to buy a home or refinance your existing mortgage. Did you know that your mortgage interest can offer you some tax benefits? Yes, you heard that right. Your mortgage interest, that fee you pay for borrowing from a lender when taking out a home loan, can potentially be tax deductible. However, this is subject to certain restrictions, so it's always wise to consult with a tax professional to understand how this could apply to your situation. Now, when you take out a mortgage, your lender provides you with a loan estimate. This handy document details the overall costs and monthly payments associated with your loan. It's a crucial tool that helps you understand how much you'll be paying in interest over the life of your loan and how that interest could potentially offer you some tax relief. So let's not look at mortgage interest as just a cost. It's also an important part of your financial strategy that could offer tax benefits. Remember, understanding your mortgage interest is key when buying a house and locking in a mortgage rate. So mortgage interest is not just a cost, but potentially a tax benefit too. Let's recap what we've learned today. Mortgage interest is essentially the fee you pay for borrowing from a lender to purchase a home. It's calculated as a percentage of your loan amount and can vary based on various factors, including the loan term, the amount you've borrowed, and your financial situation. Each monthly mortgage payment you make includes a portion for interest and a portion that goes towards the principal of your loan. Over time, this interest compounds, meaning it can add up significantly. We've also discussed the impact of fluctuating mortgage interest rates on homebuyers. When rates surge, like they have recently, it can significantly impact your purchasing power and increase your monthly payments. This volatility in the housing market can make home buying decisions more complex, which is why it's crucial to understand how these rates work and to lock in your mortgage rate when it makes the most sense for you. We also touched on the potential tax benefits of mortgage interest. In certain situations, the interest you pay on your mortgage can be tax deductible, meaning it can potentially save you money on your annual tax bill. However, there are restrictions and rules around this, so it's always best to consult with a tax professional or financial advisor. Understanding mortgage interest and how it works is not just about knowing where your money goes each month, it's about making informed decisions that can affect your financial health for years to come. By understanding the ins and outs of mortgage interest, you're better equipped to navigate the home buying process and make the best decisions for your financial future. Remember, an informed decision is always a wise decision when it comes to your mortgage. If you like this video, please remember to share it with your friends, hit the like button, subscribe to the channel, and then watch some more of our videos. Thanks for watching.